Things move fast when it comes to our current economic environment, and especially our housing market. It can be hard to keep up, so that's why this video is dedicated to bringing you up to speed on what you need to know and how it impacts your financial future. The pandemic led to major movements out of the core city centers into the suburbs as work from home took over. This has now quieted down as people are moving back into the city centers. Not to mention mortgage rates have been jacked up dramatically since the bottom lows of the pandemic. This is all done to counter inflation that is out of control as governments have put in so much cheap money into the economy to get us through the pandemic. And now, a recession is not only possible, it's definitely on the table. Home sales are dropping fast and many projects are being cancelled. A lot of buyers are now waiting for a lower entry point to get into the housing market. First, what we had was the era of FOMO, the fear of missing out. And now, we sort of transitioned into the era of FOGS, fear of getting screwed. Now, if you haven't kept up, you might be thinking, well, how's the talk of a recession? How's the talk of rising interest rates? How is all this connected to getting screwed? Well, here's an analogy to explain this concept to try to simplify this. Imagine inflation like a speeding car going down a hill. In order to slow that car down, you need to hit the brakes. In this case, our brakes are interest rate hikes. And central banks all around the world are slamming the brakes or are implementing interest rate hikes to try and slow the speeding car down. Now, the problem is not everyone is at the same level when it comes to driving ability, which means the central banks around the world are slamming their brakes. Some are doing it harder and faster than others. And if you've driven on a highway where you've been going super fast and all of a sudden you hit a traffic patch, all the drivers around you will start slamming their brakes. Some will hit it faster, some will hit it harder. And you know exactly what happens if a driver fails to hit their brakes on time. And that's how the talk of recession and interest rates are sort of linked together. Now, what's happening in the greater Vancouver area is that sales have dropped 32% year over year. Affordability was already an issue. Now, rising interest rates have intensified this affordability crisis. And because of this, many buyers are now waiting and hoping for prices to fall to offset the increased cost of borrowing. I'm sure if you've been keeping up with the channel, you've heard about me talk about the froth of the housing market in past videos. Well, the psychology of the froth in Canada's housing market has completely broken away thanks to rising interest rates. No more widespread speculation, no more pre-construction assignment flipping, and especially no more FOMO buying. In today's market, you'll actually be one of the lucky ones if you've actually bought a home and you actually end up closing it on time. Because what's happening today is that if you are a seller, you're selling your home, someone's bought your home, but they're waiting for their own home to close in order to purchase your home. Now, if they can't close, that means you can't close. Now, this whole game involves lawyers from both sides trying to figure out who they need to sue to make sure they can lock in the previous price point from February 2022. This is what it's come down to. We've transitioned into FOMO buying into a game of lawyers. Price points have already dropped 15% just from February of 2022 all around some of the higher price points of the Vancouver area and the Greater Toronto area. And with the Bank of Canada continuing to rise interest rates, what used to be you can get a 5-year mortgage rate for around 1.5, 1.75%, now a 5-year fix is going for 5% or more. Now, many of those who overstretch max out their budgets to intense levels just to go all into the housing market, you're either starting to feel the burn or you're very much about to feel that burn as rising rates continue. It's because of all this noise, distressed sellers are trying to offload as many of their properties as they can around the GTA, around the GVA. You'll probably see headlines across many news outlets that this home sold for $200K below asking, this home sold for $300K below asking. Now all of a sudden the price points are below asking, whereas previously it was all about how much homes went above asking. Now, in the grand scheme of things, going over or under asking doesn't really mean much because a house is only worth whatever someone is willing to pay for it. And what's really interesting is even the Bank of Canada has stated that the full impact of these rising rates won't actually be felt for another 18 to 24 months, which means the real economic pain of really feeling that squeeze, we're just on the tip of that iceberg. 2023 is going to be indeed a very challenging year, especially if you're over leveraged, especially if we see a recession come through. And with that, we start to see job losses. And that's when Canada is really going to feel the economic burn of basing so much of its economic growth just on real estate propping up household debt. Now, some politicians and real estate players are really saying that, well, this is not just an isolated incident in Canada. We have a housing crisis of rising interest rates all around the world. What's happening in Canada is pretty much normal. Is it though? Is it really normal, or are they trying to distract you from facing the real problem and facing the real issues at hand? Since 2000, the housing prices in Canada have gone up 3x, meaning 300% since 2000. Compared to that to the US by contrast, Housing prices have only gone up 60% since 2000. Problem is that the housing sector is such a gigantic sector when it comes to our Canada's economic pie. It takes up roughly 37% of invested capital, much more than any other diversified economy. And household debt is insanely high in Canada. For every $1.85 that we have in debt, we only bring in $1 disposable income. Essentially, we are sitting on a house of cards built on debt. Very cheap debt that was flooded in the market for the last 2 years. That's why so many people are worried about a recession, worried about rising interest rates and what that will have on that $1.85 of debt that we have for the dollar we bring in. To me, that's a very worrying stat. What about you? What do you think about household debt? And when do you think the housing market will bottom out and prices will stop falling? Do you think it'll happen later in 2022, early 2023, or maybe much more beyond? I would like to hear from you, so let me know in the comments, when do you think the housing market is bottoming out? Just a quick shout out and thank you to all those who joined the channel's membership. This content is here because of you. If you'd like to continue supporting the channel, the info is in the description. Here's another fun fact. At last count, 22% of Canadian mortgages were held by individual investors who've either bought their second, third, or even fourth property to either flip or rent. Many bought in a crazy frenzy that we saw in the last 2 years of the pandemic to try to get as much real estate possible when rock bottom rates were around. People leveraged their primary residence as much as possible to squeeze as much cheap money out of the government as possible. This was especially true for residents of Toronto and Vancouver, who were already facing some of the most priciest property levels in the world. Essentially, pandemic investors were the ones who were over leveraged and were making multiple offers and multiple bully offers to try and squeeze out first-time home buyers. So why did the government stand by and do nothing to stop this? Well, it might have something to do with the fact that many cabinet liberal ministers and just other Ottawa MPs were among those investors buying up houses in a frenzy. Demand was at a crazy high for real estate during the pandemic, whether it was your mom and pop investors, your government ministers, or your friendly neighborhood corporation. Everybody wanted to slice that real estate pie. Not just a slice, but as much of the pie as possible. Everybody wanted that sweet, sweet real estate money and profit. Now with higher mortgage rates because of simple economics, we're seeing a drop in demand for housing prices, leading to a correction in some places. But not all pressure will disappear from the market. Many real estate developers will start to either back away or slow down the construction of homes because of their profit margins becoming smaller. That will mean that will be much less housing available just down the road. Not to mention the fact that Canada is on track to bring in nearly 500,000 new immigrants into the country. Add on another 150,000 worth of international students. Plus, close to 450,000 temporary workers, which will put even more pressure on our crazy rental market. That's the frustrating point about Canada's real estate market. Whether you're a renter, whether you're a buyer, it's just frustrating. Now, unless you're in the minority just making a ton of cash on real estate, then you love it. But just for the regular people out there, it's just so frustrating. Now, this question I hear a lot, whether you're a first-time buyer trying to get a first property or whether you're moving or your mortgage is coming up for renewal. Should you get into a variable rate mortgage or should you get into a fixed term? If you know for sure you're going to be in your next property or the current property for at least the next 5 years, then a fixed rate option is something you should consider. Now, what's really interesting is that over 50% of Canadians end up breaking their 5-year mortgage term early, often incurring huge penalties to break that mortgage. So that's just one factor to consider. It still remains a buyer beware kind of market, even with the softening demand and drop in prices. Now, if you're thinking that the housing market has only been unaffordable in the last 2 years when everybody was getting into housing due to that frenzy, well, in reality, it's been much longer since the housing market was actually considered to be affordable. Based on the income to housing ratio, Canada's housing market was last affordable back in 2004. But there could be a way to address the cost of housing in Canada, especially affordability, in the next decade. New research on the CMHC has looked into what Canada needs to do, what Canada needs to bring back in order to have affordability again, which is something we really haven't seen in the last 20 years or so. Back in 2003 and 2004, the average household in Canada had to put somewhere between 36 to 38% of their disposable income in order to make sure they can continue to afford a home. At that time, the provinces with the highest housing ratios was BC at 45% and Ontario at 38%. Today, however, the Canada-wide average of how much it takes of your disposable income to put towards housing to make sure you can afford it is 60% or more. So as you can see, just based on that one metric, how far we are removed from affordability. It's no wonder why Canadians face the least affordable housing market in more than a generation. Home ownership is now very much hard to obtain, especially if you're in lower mainland BC or southern Ontario as a first-time buyer. Higher interest rates is going to affect virtually every single buyer across the country, hitting you with higher monthly mortgage bills, making it that much harder to acquire additional properties, or even just pay for your existing property. Now, whether you're considering buying a property or renting a property, it's so critical to make sure you check your credit score and understand what that means for your personal financial situation. Check out the link in the description below on how you can check your credit score for free in less than 3 minutes from Borrowwell. While you're at it, you'll also find links to other great services and products where you can get $100 in free sign-up bonuses from other providers, so check it out. Continuing on with the housing affordability issue in Canada, if we take a look at the average Q1 price that we saw in 2022, a 1% increase in mortgage rates would mean that a typical mortgage in Vancouver will go up by close to $604. And in Toronto, that means your monthly mortgage goes up by close to $554. The market conditions we are seeing today is causing a downward trend in demand and putting downward pressure on pricing, causing a rebalancing of market conditions, meaning we're no longer just in a seller's market territory, we're sort of transitioning to a buyer's market territory, where we went from having no absolute conditions on any offers, where now buyers are starting to put conditions on offers again. Now for affordability to come back to Canada, that means the housing pace of new build must at least double by 2030. In other words, 3.5 million new homes need to be added by the end of the decade, on top of the existing 2.3 million of housing units that are already in the pipeline for Canada by the end of the decade. There needs to be a drastic transformation in our housing sector. We need support from all levels of government, from all the way from policies and procedures. We're at a point where we need to see an all hands on deck approach when it comes to increasing housing supply. This needs to be a focus. This needs to be part of the discussion. Not just a discussion, but it needs to lead to actionable steps. According to a recent survey by Canada Life, nearly 50% of respondents who rent, they said that they will continue to rent indefinitely. Meaning half of those respondents in that survey have completely given up on the concept that they will ever be able to afford to buy a home. The challenges we face around the housing market is making it difficult for renters on how they would transition, let's say in the next 5 years, from a position of renting to a position of ownership. That's why many people, especially young people, first-time buyers, have completely given up on the thought that they would ever own a home, especially in either lower mainland BC or southern Ontario, without having to borrow money from parents or other relatives, or maybe moving across the country to the prairies and moving away from family. Continuing on with the survey, 64% of respondents also said that the only way that they would be able to enter the housing market is if they have financial support from others. Now, if you already own a home, it doesn't matter all that much, as you're selling into the market, the same market you're buying. But for first-time buyers, you're going in, you're jumping into a market with zero equity. That makes it so much harder, not just harder, but almost impossible. You're just getting squeezed from all sides, whether you're paying a mortgage, whether you're renting, whether you're paying gas, going to work, everything just costs more. And the problem is that the prices of all these goods and services are actually rising faster than your earning levels are. We're kind of caught in the middle of this market shift, where rising interest rates are causing you to pay more for your monthly mortgage. And even though house prices are dropping, they're still expensive enough where you need more upfront down payment in order to get into the housing market. A lot of people I speak to, they're telling me they're going to wait until August or till September to be active again. They want to see what the next interest rate hike brings, which is expected in July, to see what the fallout is in the housing market. Going into the second half of 2022, it definitely seems plausible that more and more homes are going to pop up within your price range, as there's still plenty more rate hikes to come. Thank you so much for watching. Hopefully you had some meaningful takeaways from this video. Make sure you hit that like, subscribe, and thanks button. And check out all the links in the description below for some amazing discounts and sign-up bonuses worth hundreds of dollars. That's it for now. I'll talk to you in the comments section.